45 years, 0 name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
Welcome everybody. Thank you all again so much for joining us. Pat Prunty here with us as well. We're just really excited to be able to have this opportunity to review the quarter with you folks, to go over the mortgage fund. It's all great news for us, right? The fund is performing exactly how it's been designed, and it's really nice to say that after Pat and I were discussing, it's been 6 years. This is our 24th consecutive quarter. We do these presentations at once after every single quarter, and we love to get feedback. So if you guys have questions or specifics that you want to be covered in future presentations, we love that feedback. I'll be doing follow-up calls, and feel free to type it into the chat box. But we want your feedback, and we want to make sure that we're presenting the best possible presentations we can. So my name is Vince Tomich. I am an advisor and fund consultant. I work out of our Newport Beach office, and I've been with the company now for almost 7 years. I work very closely with Pat, the private lending team, as well as all the other teams in our office. It is a great honor to be able to participate and work so closely with the mortgage fund, as I feel like it has been an amazing vehicle for those of you that are looking for that passive and consistent, safe investment. And it's been a great resource for us, for myself, personal investing, and for our clients seeking that kind of performance. So I get questions all the time, right? How does the fund work? And, tell me more about the fund. And we're going to get into all of those specifics, right? There's a large portion of you folks that are on our tonight's call that are current fund investors, current capital partners, and folks that are new. The folks that are, current capital partners, oftentimes, people may forget where to kind of track your investment, right? And we like to be able to kind of make sure we remind everyone where to get that data. It's so important for those of you that have stocks and retirement accounts where you can find that information. And this functions this exact same. So we have an online portal that you can find on our website, and we took some screen clips here to show you where to go. But you would, go to the Marshall Reddick website and then investment fund portal there, and that would prompt you to your Marshall Reddick login, where you would have your email and your password, and that's where you get onto the fund portal. Pat was also nice enough to include this QR code. This QR code is great because you can click this from your phone, and it helps kind of fast track your way to the portal.
I mean, the bottom line, folks, is that we get constantly asked, like, where can I track my investment? Right? Your statements are uploaded every single quarter. Your tax forms are going to be there. Vince is going to dive a little bit more into that, but we want to just make sure that everybody knows that resource is there for you, and it's very easy to get there right from our website. We all know we've got so many URLs and passwords for different things as we're trying to manage our lives. So if we can make it a little bit easier for you with a QR code, and think about all the people that are going to be watching this on a recording as well and not necessarily live.
Yeah, and speaking of flexibility, the nice thing too, and I use this often, is we do have a mobile phone app. So for those of you that aren't really logging into your computer much or don't have that kind of access, and you usually use your phone for all of this type of monitoring, it's great to know that we do have that app. This is also a QR code to get to that app, Investor Portal. I use it all the time, and it's very user friendly. So another perk for those of you that may not be aware how to track your existing investment. Okay, so here's what a snapshot for those of you that may be unfamiliar of what the online portal looks like, right? So right when you log in, this is kind of the main dashboard. This is what you're going to see here. What's really cool about the dashboard is if there's any new information, any notes, any memos, anything from Pat or the team that is important to share, usually you'll have that information here, right? So you'll be able to kind of get updates as the quarter moves along, that's usually what you're going to see on the dashboard section here. And you'll see this, I'm going to work my way down on this, these tabs on the left-hand side where you see dashboard. Next one is tax forms. We get this question all the time, right? When's my K-1 going to be here, right? So we do have a little note there about it won't be until after March 1st, but when they are available, you will be able to source them in that tax form tab. Documents is also going to have all of the pertinent documents involved. If you've uploaded documents to our page and all of the other kind of documents associated with the mortgage fund, you'll be able to find those documents there. And then transactions, this is also a really important one. This is going to track all of your contributions, all of your distributions, and just be able to keep that tally of accumulated capital as you move on. And, you know, the longer you spend in the fund, the more capital that you may accumulate or the more contributions you make. So this can help kind of simplify and be able to track that. And then lastly, you're going to have contact us. So if you ever have a situation where you need to get more information, you can always contact us through there. But of course, myself and Pat and the team, we're happy to share our contact information for direct access as well.
I think one thing to mention here, Vince, is the my profile is very important as well. Not only can you update your contact information there, but you can also connect bank accounts. And this is the safest way to do it. In our line of business, like wire fraud and bank fraud is rampant, and we spend a lot of time and resources to safeguard what we're doing. Okay, so coming in here using a Plaid integration that is going to be able to tap in through the banking apps, and you can connect accounts, and like we don't actually, a lot of times get to see the account information, right? It's all done encrypted, and I'm not a tech guy, but we looked into this heavily, and this is a very important part of our software. So again, connect accounts where you can transfer funds to us, whether that's your initial contribution or future contributions, right? Or it's also where we can have access to electronically deposit funds from distributions or from redemptions when it's time to redeem, as opposed to us trying to verbally do it. And certainly we do not want to be emailing banking information. So I just encourage you to get comfortable with the portal, as Vince is talking about. It's very basic, but it's extremely helpful.
Yeah, absolutely. And any questions or technical scenarios that you may run into of inabilities to make those connections, please don't hesitate to reach out. We're happy to facilitate that. So anybody who is new to the mortgage fund, I encourage you, there's no such thing as silly questions, or I'm happy to spend as much time as possible to explain what the mortgage fund is, what, any specific questions. All new inquiries are welcome. So I like to just kind of take a step back, make sure that everybody has my contact. I deal with a lot of the folks that are first exploring the mortgage fund. Oftentimes it may even come from a source of, hey, I was looking at real estate, or I was looking at property management, but this piqued my interest. So I encourage you, those folks that are new or that are unfamiliar with the mortgage fund, or maybe somebody that might be interested, this could be a good fit for, please, happy to take those inquiries and pass that information along. Okay, without further ado, I want to introduce Pat Prunty. Pat is our fund manager, created the mortgage fund, and is the, runs the day-to-day operations. So love to hear from you, Pat.
Absolutely, and my pleasure to be here with everybody. First and foremost, just thank you for the opportunity to be of service. What we have built with this fund, what we have built with our private lending program, it does not work without the capital. And we've got a fantastic turnout tonight on this quarterly call. And I just love being able to show up, being able to explain what we're doing, and share just a little bit of the inside track. And, I'd love to speak to all of you. It's becoming a little bit more difficult as the fund has grown in terms of capital, in terms of investor count, in terms of staff that we've had to hire to safely manage this fund. So it's not that I don't want to, but I am empowering those around me. So Vince is one of those. So I do encourage you, he's extremely knowledgeable. He's been an investor in this fund since we started it. He also sits on the board, if you'd like to call it that, We have heavy management meetings in terms of implementation and decision making and underwriting and different guidelines and different metrics, right? So he knows what the people at the round table and the inner workings that are happening just the same as I do. That said, I do still have the opportunity to speak to you. And if anybody would like to come down to Newport, if you're local to Southern California, you find yourself on a vacation, please look us up. We're right by John Wayne Airport. We'd love the face-to-face interaction. We'd love you to come see our operation, whether that's, again, our lending team or the greater team, which includes our real estate brokerage and our property management division. Taking that a step further, we've set up a group email for investor relations. This isn't necessarily for first-timers with questions, right? Should be chatting with Vince or one of our other fund consultants. But there are many nuances that you may need assistance from time to time. I find one of the most regular questions we get is about redemption, right? Getting your money out of the fund. What is the time? Are there fees? When's the good time to do it? Can I do it mid-quarter? Do I have to do it at quarter end? I am not always able to answer those questions, right? I am on this email here that is a group email, but also who is here is some of our team on the accounting side and some of the folks that are on our board. This is going to be your fastest way to get the most pertinent information that you need, whatever the topic may be. So I encourage you to use this. And again, you're certainly welcome to copy me or call me, but if I'm slow to get back to you, this is the fastest way to get the information that you need. Also, just to reiterate there, we're fast at work, right? There is heavy reconciliation that goes on just so that our accounting is trump tight, right to the penny, as you would expect with a fund of our size and the size of our team. And so it's not that your tax documentation is not important. It absolutely is. But K1 in a partnership scenario is not as easy as you would think. Certainly not like a 1099 INT or other 1099s that you might get that are predicated just on dollars that were released to you. There's a lot of other items that go into the partnership and into that K1. So we are heavily underway with the CPA firm, and there's just unfortunately no possibility of getting those K1s prepared, reviewed, double reviewed, and uploaded into the portal before March 1st. That is always going to be our target date, and we're very conscious of those business investors of ours that have the first March 15th IRS and state tax due dates. And then, of course, of those of us personally who are investing with that date on April 15th. So it is our desire to get it to you by March 1st, and we will publish another team through the portal correspondence to let you know that your K1 has been uploaded, and it is available for download in that tax tab, as Vince mentioned. All right, so I would like to get into the meat and potatoes. Always good stuff, and I am just so thrilled about the performance of this fund. We didn't know what to expect. Heavy analysis on the front end when we were setting this up, and setting it up 6 years ago comes after 10 years of tinkering in the private lending space. And we continue just to focus on what we do best. And I'm going to dive into a little bit of that now, but I also like to add the growth of the team. We've hired recently an underwriting manager. Her name is Parisa. I'm going to have her join me on the next quarterly call, and you can hear from her a little bit, but this is another leader that we've added to our team to help us. She comes with a background from the small business administration and has a lot of credit and capacity and the 4 C's of underwriting, bringing that to us. So we need to stay a little bit low red tape that would be expected from the hard money space, but without compromising quality of borrower and underwriting guidelines, which are becoming so important as we raise capital and our origination count goes up, because there are bad apples out there. But we are determined to do this correctly and to continue to release quality, profitable distributions each and every quarter. So capital has gone up and continues to go up. We're going to be over 80 million as soon as we move in the dollars in our subscription account. So we're right there. Capital partners continue to go up. As Vince mentioned, we're celebrating our 6th anniversary. That will be in March of this year. Pretty excited about the 8.49% average annual return. I'm going to define that a little bit more, but that is certainly just at our entry level tier. And for those who are already investors, you know that we have 3 tiers that are based on capital account where you can earn higher than that on an average annual basis. Portfolio continues to grow. We're going to be approaching 300 loans in the portfolio soon. That is active loans that are right now, okay, in the portfolio. That is outstanding. And that's a hard number to keep on an upward trajectory. Remember, we are short-term lenders. Our loan target in terms of term is 12 months. So after doing this, after 6 years, I mean, we literally are getting multiple payoffs per day. That means that not only do we have to replace that, but we have to continue to grow the origination count. So really excited about that, because that also goes to show the diversity of this fund. I used to think that I was going to be able to bat 1,000 or shoot 100% from the free throw line. And I've learned that that's just not possible. And I've learned that as a part of running this fund, you are going to have defaults, but that's okay, right? We've penciled that in, and the diversity of the fund as it continues to grow, our default rate has not increased. The count has, but that's only because we have more loans, and we've penciled that into our metrics, and we've penciled that into our yield, and we deal with those accordingly. That's one of the best parts about being in this fund versus being a trust deed or a mortgage investor in our program, because that's a whole other side of our business that supports our private lending team. And specifically what I mean by that is that we as a management team, we deal with those defaults internally. We can move on them quickly, right? We've got, again, 275 loans in the portfolio that have us, that's not even a blip in terms of the yield when we have a default or two, where you as an individual may not have that size of capital and not be able to have that type of portfolio, and you catch one of those defaults, that can be catastrophic to your portfolio. Okay, so there's safety in numbers is what I'm saying. Loan to value continues to stay under 65%. That has always been our mantra. We are going to keep it that way. We are continuing to focus on single family home. This number continues to march towards 100. It will never be 100. We do some multifamily lending. We do some land lending. We do, even more than the 2 to 4 units. We do some condo and some townhome. But the major focus is single family home. It's the most easily valued. It is the most easy asset to dispose of in the event of default. Okay. And again, hyper focused on the short loan terms. So 80% of the portfolio turning over every 12 months. It's beautiful, right? It allows us to reprice the interest rate in a volatile interest rate market. It allows us to be competitive with our fees when we need to. Obviously, from your guys' perspective, we'd love to charge the highest interest rate and the highest fees. That's always the goal, to drive yield. But we don't want to be chasing borrowers without experience, first timers, right? We want to stay ultra competitive in terms of our offering so that we are attracting the best quality borrowers, high credit, right? High capacity to be able to undertake the focus for us, which is again going to be value add transactions. These single family homes here, these need work. We're recreating neighborhoods, folks, right? You have a hand in that. One of the metrics I'd like to share here, Indiana, top count origination state for Marshall Reddick private lending in 2025. We are doing a lot of loans in and around the suburbs of Indianapolis. Again, our borrowers are in those neighborhoods. They are buying these homes that need work, that need to be improved. And one of the coolest part about our jobs is being able to see what they take it from and how beautiful it is, and then dumping back onto the market, that newly fixed up, brand new everything, right? That's spawning that neighborhood and building that city. And we're doing that all around the Midwest and in the South, and of course here a little bit on the West Coast as well. We're getting more into California, and we're having, excuse me, the ability to do that as capital raises. We haven't been heavy in California because the loan amounts are so high and our fund has been so low in the grand scheme of things in terms of AUM, right? So we don't want to over lever our fund with a handful of California loans at $2, $3, $4 million. Having one of those that just blows a hole in your diversity model. So one of the things we're going to talk about is our average loan amount, right? And why we focus to keep it that way. So that helps our diversity model. So and specifically when it comes to Q4, new record, as it should be, as we're continuing to raise capital, right? An amazing origination feat. The team was just firing on all 7 cylinders with 71 loan originations for nearly 25 million, and rounding out the year with 242 loan originations. That's just in our fund. For the record, we had 557 total originations in our private lending program. Okay, so what we're seeing here is just the fund. Right, and the fund continues to grow, but the direct lenders do fill a valid, almost like a credit line for our fund, because we cannot do all of the loans. We just don't have the ability to do it, at least with the fund. But super proud of both of these numbers. These both exceeded expectation.
Nice, Pat. So, and the demand for private capital remains very strong. So in addition to helping raise capital for the mortgage fund and participating on the lender's side, I'm also working with new borrowers and borrowers that are coming to use capital from us, whether it's fix and flip or bridge loans or new construction, right? So I am now also participating in understanding their needs. And to Pat's point, one of our big differentiators for the fund is the existing relationships we have with some of these borrowers. There is long-standing relationships that really value our partnership. And I think that establishing that early on with new folks, maybe we're not the lowest rates, but we're definitely not the highest rates. But what we want to identify is trying to provide the best teams that we can so that we have a very smooth, systematic process as we've established thus far. Instead of, as Pat mentioned, chasing the highest possible yield for maybe somebody who's never done this and it's a more risky loan. So we feel very good about the borrowers that are coming in. And for those of you that are considering adding to your position or getting someone else that that this could be a good fit for, we are in seek of always of more capital. Here's a quick snapshot, just an illustration of the capital growth from inception. So you'll see we're starting here Q1 of 2020 and just see a nice steady increase in capital, just as we planned, just as kind of we forecasted in our original docs to create the fund. So quarter over quarter, nice, smooth, continual growth to marching to that 100 million mark.
Yeah, and Vince, as you move on to the next one here, I just wanted to add that this is net, folks. Right, so this includes people that have redeemed. The one that Vince just showed was capital, and he's going to tell us now about the investor count. But we've already exceeded our raise, right? Our goal was to raise 100 million, right? And we're going to get there from a net perspective. But we've already exceeded that with more than 20 million that's been redeemed out of the fund. And that's really something that's important to me. Right. And I've realized that it's really important to investors that want to come in is liquidity. Can I get my money out? Can I get it out quickly? What is the mechanism to get it out? And I just want to reiterate that that is extremely valuable. And one of the main reasons that we're hyper focused on those short loan terms, that gives us the ability to get people out quickly. Right, whatever the size of the capital amount, that allows us to continue to originate loans quickly. That allows us to process our construction draws to our folks that need those quickly. And we've done all of this with no leverage, right? Straight equity, no debt on this fund. So sorry to interrupt there, Vince.
Yeah, no problem. And this illustration definitely shows how we've grown our capital partners as well. As Pat mentioned in the beginning, we're right at about 340 capital partners. And I'd like to share a quick just kind of personal experience that Pat mentioned for the fund. That ability to exit, that ability to redeem that capital for other things is really important to us, right? I personally used the fund in the very beginning as a high yield savings account. I used that and I continued to make contributions, continue to stick in there until I had enough for the down payment for my primary residence. And it was so nice to be able to communicate that with Pat, explain the program, explain the plan, so that when I needed those funds, they were ready to go. And that is not an exception because I'm an employee. That is something that we can create for any of you folks that have some kind of plan like that, that have future intentions with capital. If it is a more of a short-term savings plan, great. If it's more of a long-term passive play that you just want to continue to clip coupons, we're here to support that as well. But that redemption element, I think, is is a big differentiator of our fund.
All right, let's get back into some of those metrics from Q4. As we do that, we got a couple of questions from the crowd. So AUM is assets under management. Sometimes we also refer to it as NAUM, which would be net assets under management. Also have some questions about the average in time and the average out time. Very hard to predict. Currently, we're running about 35 days on the entry, and we're at about 45 days on the exit. Both of those significantly faster than what is stated in our operational documents, which if you dive into that private placement, you will see that the number is 90 for both of those. That's a big goal of ours, right? We need to set expectations correctly. So I hope that's helpful. Okay. Really getting back to the count, right? And I like to show the comparison, 71 versus 53 and the 23 versus 14. We're able to do that in this quarter because we had a good capital raise quarter and also a good payoff quarter. We're getting a lot of capital back. I don't know how that always seems to work, but we have seen a trend that there's a lot of activity in the fourth quarter. I think it might be that us normal folks, right, if you want to call us that, we kind of go to sleep a little bit. We're spending a lot of time with family around the holidays. The entrepreneurial mindset, however, those folks, my borrowers, they're out on the prowl. They are talking to, tired landlords potentially that are like been, high days on market in terms of their listing, and they're now taking under market offers. And I'm telling you, to be a successful flipper or wholesaler, I mean, you got to make 50 offers a week and expect to just get the heck no most of the time in terms of your offer. But I think that that's at least my hypothesis in terms of why Q4 there always just seems to be a spike in activity when a lot of businesses are sort of have a down period. Average loan amount, I referenced that a little bit more, so that's jumping up. That's great. I'd like to see that. I like the higher loan amounts, and I like that because I have learned that I like nicer assets. Okay. Generally speaking, the higher the loan amount is going to be the higher the property value. And we're going to be talking about really nice assets, which means really nice neighborhoods, which means really good school districts, which means properties tend to hold their value better in the face of potential economic downturn, right? And let's not be foolish. We're just like you guys, and we're watching the news and we're watching the metrics, and we're in interesting times. But I don't think there's a better place that I would rather be in first lien secured private credit. And I'm really glad that that's where we are, especially when it comes to residential real estate. I always like to dive into the weighted average interest rate and term, which are, I'll compare those to the money coming in and the money going out in the quarter in a minute here. So in terms of payoff data, the number of loans coming in was actually down compared to Q3, but we had a lot of capital on the books after Q3. But you'll notice that those 53 loans, we had some large payoffs, obviously with volume being higher with much less loans in Q4 compared to Q3. And then you see again that average interest rate, weighted average interest rate and weighted average loan term and the comparison. So this is really where the analysis and the comparative comes together. And this is like what my goal is. And I get giddy about looking at this every single quarter. So capital coming in the door, 19.5 million, right? And that money was paying an average interest rate of 9.36. All right, not a bad interest rate. And the average term was over 12 months, which means that we had some, some long-term loans that we're paying off. We do some 36-month, some 60-month loan terms, and in our infancy we did even some longer than that, right? So we're getting some of that long-term debt that's maturing, that's paying off. And then we're pushing out the capital, we're pushing out more, 23.5 million this time, and we're pushing it out at more than a point higher on the average interest rate. And we're pushing it out at a almost a full month or more than a full month on the average term. Okay, so money coming in and money going out. And if we can push the money out at a higher yield on a shorter term, that's going to drive yield. So we got to keep watching this metric, and this is one of my favorite to talk about every quarter.
I think one thing just to add there, Pat, is, just for people to understand the way that money comes into the fund to redeploy is kind of two ways: through the payoffs that Pat is mentioning, and redeploying that at a higher interest rate is going to have a direct impact to benefit to you. And the other way that the fund grows is by new capital, right? But for Pat to be able to take money that we're already paying interest on and just deliver more of a return to you is a huge benefit. So that's really great to point that out.
Thank you. All right, business as usual. And just a quick snapshot, I am going to show the financials. The financials are always available. We publish those every quarter. They go out with the memo that you get and your investor statement that's inside your portal. We also post them for the public on a mortgage fund page that we have on our website, just to know that those are there. But this is a summary of that, and then just a comparison compared to what the prior quarter was. All right, so pretty status quo. Net income continues to grow. Again, a new record. I'll be super excited to see that get over the $2 million threshold. And again, when we get into this, you're going to see we distribute 100% of the capital every quarter. So it's revenue coming in, expenses, net profit, and we're distributing 100% of that net profit, getting back to ground zero to do the same thing each and every quarter. I've added here for the first time a little bit of summary from the balance sheet, which we're also going to show, just because I think it'd be cool to show the continued growth in loans receivable and also total assets. Okay, and so most of our assets, of course, are loans, but we have other assets that namely would be cash, that would be interest receivable. There's some other things that I'll be showing on the balance sheet here shortly that we've had some questions about. So that net income or net profit, whatever you'd like to call it, of that 1.8 million, that represents 2.41% of the capital under management during the quarter. And keep in mind, this is not an easy number to calculate. We have massive software to be able to do this. And the reason for that is because the capital starting the quarter is not static and end the quarter. Right? That's one of the coolest things I think about what I've learned about our fund compared to others. A lot of others allow you to entry only at quarter start and exit only at quarter end. Okay, and we don't do that. We allow investors to come in and go out every single day, which makes that calculation much more complicated. All right, so but if you were to do the quick math of 1.8 million divided by 0.0241, you'd get around a $75 million number, which is right there where we've shown you that assets under management is. That annualizes at that 9.62 number. That's just multiplying the 2.41 times 4. And as Vince alluded to, 24th operating quarter since our inception of this fund in 2020. And I'm so proud of the fact that we just haven't missed one, right? And we've been right around that 2% distribution. And again, that 2% number that I'm quoting, that's going to be at our entry level tier. I'll get more to that as well. So I understand that because we're showing our lovely faces here, which we love to do, that your screen might be a bit small. So again, you can look for this P&L on the website. You can also look for it in with your statement, but that's what we have here. And I just always like to kind of run through the metrics to show how this works. Everybody's getting the same 1.5% preferred return, which is a 6% hurdle. We have to cross that hurdle every quarter before we as management participate in the profit share element of our fund. All right. So the profit to split this quarter comes in at north of 700,000, which against capital under management is just a hair under 1%. All right. And there you can see our 50, 60, 70% profit splits. Those are our 3 different levels, and those are based on your capital account. So the base at 50% is for capital accounts under 500,000. Total to the capital partner, right, is just inclusive of your preferred return and your capital account based profit split to get to the total earnings distribution per capital level, if you want to call it that. And then again, just multiplying that by 4 to get us to our annualized number. Ties right into the P&L. All right, the balance sheet. And this is important. I've been getting a lot of questions, not an overwhelming number, but there are some items on the balance sheet that people are just a little bit unsure what those are. So I thought I would speak to those this quarter. Namely, that's going to be our allowance for expected loan losses, which you can see they're boxed, as well as deferred loan fees. And then at the bottom part in the liabilities section, we have lender draws on hold. Okay, and I think that that number has been pointed out, that latter one there, because it's now exceeded 10 million, which is a big number. But I'd like to speak to each of these 3 accounts because I thought it would be helpful for all of us to better understand that from a financial perspective. So the allowance for expected loan losses, okay, this is an accumulation of revenue that we have accumulated since inception. Right, so this has just been growing quarter over quarter for 24 quarters, okay? And this is a bucket of money that is used to offset actual loan losses when they occur. Again, I mentioned before, I'd love to, bat 1,000, and I keep using the baseball references. I'm a big baseball fan and was out on the field tonight with my son. I'm coaching Little League, which is just fantastic. But we're not going to bat 1,000, okay? We are going to have loan losses. We have had some. And the loan loss reserve, or the allowance for expected loan losses, this is a part of GAAP accounting. This is a part of debt funds. This is something that a bank has to do, because just like a bank, our fund will experience losses periodically when we either have to take a property back, or maybe strategically we have to let a property and a loan go in a short sale situation. There are many different loss mitigation tactics that we will go to, right? But this is a really good number, right? This is more than 0.5% of capital, right? For a fund of our age is right where it should be, okay? So I feel very good about that number. We're going to continue to drive that number up. This is also, as time marches on, we are able to use this and return funds to the capital partners, if you want to, as a bonus, if you would like to call it, right? But it's all based on an annual review of like, what are our historical losses, right? What's in our current portfolio and potentially our problematic loans, if any, as well as like the economic outlook, a supportable economic outlook. Okay, so I have to take those 3 metrics into an annual analysis, and this is what our CPA firm is requiring of us when reviewing the metrics of our debt fund. So again, that is to speak to the allowance for expected loan losses. As far as for the deferred loan fees, this is another GAAP accounting mechanism that we have had to bring in that has not always been the case with our fund. And this speaks to loan fees. We collect upfront loan fees on every loan we do. That is standard to the lending industry. But we cannot collect or put that revenue for those upfront loan fees on the books as revenue when earned, which is at the point in time when the loan is originated. And instead, that loan fee or loan fees has to be amortized across the term of the loan. So for easy numbers, if I have a $1,000 loan fee, or let's say a $1,200 loan fee amortized over a 12-month loan term, I have to bring in $100 per month over that loan term. And if it doesn't go the whole loan term, let's say it goes 6 months, well, I would bring in 100 for 6 months and then bring in the $600 balance at loan payoff. That might be a little bit over your head. Just understand that that 548,000 number right there is an accumulation of these loan fees, and that number goes up and down, right? As time marches on, it goes down because we're bringing that money in as revenue onto the P&L, and it's also going up as we originate more loans. So I hope that's helpful. And again, we are required to amortize each loan fee over the life of each loan. Finally, let's get to those lender draws on hold. That number is over 10 million, but that's a comfortable number, right? And that 10 million number is buried into loans receivable, which is up on the asset side. That's right above where my box is there. It's 85 plus million. So that 10 million is included in that, but that 10 million again is an accumulation of capital that's been borrowed, technically borrowed, but has not left our fund yet. Okay. We are very strategic with how we manage our funds control. And this is renovation or construction money that we only release in reimbursement style after heavy evaluation of visual evidence from the borrower. So in other words, the borrower that wants to borrow against the improvements to the home that they've purchased and borrowed money for the purchase, right? They've got to go start improving the property and complete phase 1 of that improvements and show us what they've done. And then we reimburse the work that's done and we distribute. Again, this $10 million in this lender draws on hold, it goes up and down. So as more construction draws get requested, we're lowering that number. And as more loans get originated that have holdback, that number is going up. So this is money that we're going to get called for at some point in time. And we've become extremely good at managing our cash flow that we can always meet the obligations of that dollar amount. So again, thanks for the great questions this quarter from those who asked those. And again, as Vince mentioned, we would love for you folks to email us, to call us, to write into the chat. What other metrics and things would you like to see on these calls? We'd love to dive into those. This is a very transparent fund in the way that we do things at Marshall Reddick. And so if you have questions, let's get them answered.
Awesome, Pat. And then, just for those of you that are tuning in or that continue to tune into these events or these webinars for more information, just know you can find basically live updated data as to how the fund is performing on the Mortgage Fund webpage. So you go to our website, and of course there's a nice QR code to zip to that. But if you're in front of your computer, you would go to our website, marshallreddick.com, and then invest to the Mortgage Fund. And you can find that data, how many, active loans and where the loans are in each state. And there's just the capital and the quarterly or in the year-to-date return are the only things that adjust annually. Everything else is live up to date. So, and then just taking a quick step back, for those of you, we've been assuming or speaking to a lot of folks with the assumption that you're actively participated in the fund or a participant of the fund. So you're pretty familiar with the inner workings, but there are many folks on the call tonight that are brand new to the fund, that are exploring this as an option. So we wanted to take a quick step back just to recap as to what is the fund, how it works, and Pat will kind of jump into those specifics now. Yeah,
always good to know what is Marshall Reddick Mortgage Fund, right? So to know what the fund is, you just have to know what our private lending program is. And I understand a lot of you do, but there are a good number of new folks on the call. And so again, we are hard money. We are non-QM, right? We are doing completely and strictly non-owner occupied. Short-term loans is the major focus. It's got to be first lien position with title insurance and third-party escrow on every single transaction. There is just no other way to do business in the debt space. We've got to have good loan to value, and we're really focused on the real estate entrepreneur, right? Someone that's doing this full time. We don't want the weekend warrior. And there are a lot of these folks that are very creative and have found an ability and a niche that they're good at. A lot of design folks, a lot of contractor folks, a lot of wholesalers. We're working with a lot of wholesalers. But we're always secured against residential real estate. So we will go above 4 units. A lot of folks feel that maybe a 5 or units or above is not considered residential. To us, in our definition, it is. You have to live there, but we're not doing any mixed use. We're not doing medical, industrial, anything like that. That's just not our bag. There's a much smaller market of buyers for those types of assets, and that's a much different underwriting set that is not our focus. So if now that you know what our private lending program is, then you can understand what the fund is, because our fund is the biggest capital partner in our private lending program. All our fund does is fund fully underwritten and approved loans from our private lending program. And we structured this since inception as a Reg D 506C. So you can Google those if you want to learn a little bit more about that. There are many different variations of Reg D. This will be changing. We've been talking about and planning for that REIT conversion that is underway. So there will be a change, but currently we still are that partnership. We operate in perpetuity. You can call it an evergreen fund. There is no end date to the fund operation, and there never will be. And there's no end to the capital raise. There's always a methodical raise to help us manage that cash flow. Right? People need to exit. People need construction draws, and we need to continue to grow this fund. Our goal initially was 100 million. I see that is coming. I see that goal in sight. But I think beyond that, now our goal is going to move to 250 million, and that is going to happen with the REIT conversion and audited financials. Our waterfall will stay the same, however, with a very simple preferred return and a profit share. There are no load fees. There never has been. There never will be any load fees, right? So we're not charging you to enter into the fund. There is an asset management fee, very common, right? That is collected monthly, and that helps run the private lending department so that we can operate the affairs of this fund, because the fund has no employees, right? Vince and I are both employees of Marshall Reddick, the operating business. Okay, 100% of the net income distributed quarterly, as we talked about, and that is based on your percentage of ownership and your tier. So as I mentioned, strictly funding approved and fully underwritten loans by Marshall Reddick. That's just how I like it. Minimum investment still 25,000. We're toying with the idea of raising that. I really think that number should be more about 100. 12-month minimum hold, that will not change. That is a very comfortable number that gives liquidity, just the right amount of liquidity. And understand that the 12-month term on your initial onboard, that is only the initial onboard. After your initial 12 months, you do not sign up for perpetual 12-month terms. Okay, it's like a month-to-month lease thereafter. But do understand that if you're going to start dripping in capital or make additional contributions, each contribution runs its own individual 12-month initial term. Okay, you can invest or contribute more as needed. You can also redeem and withdraw as needed. And I've had a lot of folks, not only on our team, but in our capital base, that withdraw when they need for something big. Might be sending your kid to school, college. It might be buying a new home, right? It might be any number of those different things that you need liquidity for. If you need it, you need to let us know, and we will put you into the queue, and we'll be very proactive in our conversation with you about the timing. The preferred return we talked about, and the profit splits. The automatic reinvestment, this is absolutely a game changer for self-directed retirement accounts. It is so difficult to run your own life in your household and your work and your children and go on a vacation once in a while. The last thing you need to be doing is managing your own retirement funds. Difficult to do. So if you come to our fund, right, you can just very simply collect a check every quarter, and you don't have to take it. You just add it to your capital account and earn on your earnings, right? This is a beautiful thing, compounding. So there's no UBTI for those that are more familiar with self-directed retirement accounts. That's unrelated business taxable income. That does not exist. There are carve-outs for the lending business and model that we have. So understand that your self-directed retirement account is safe. You must be an accredited investor, and we are still distributing K1 annually. That will change with the REIT conversion. If you're curious what an accredited investor is, you'll speak to Vince about that and understand. Not difficult to qualify. It's either you are or you're not. So moving along, just understanding from a basic, understand what is the fund purpose. It is twofold, right? Number one, to provide clients with a safe and consistent stream of income. All right. And our targeted annual return is going to be that 8% in the form of 2% quarterly distributions. We haven't missed that, right? That's predicated by our average annual return since inception at about 8.5, right? And to distribute a profitable quality distribution every quarter. And if you don't want to reinvest your earnings, don't take them, spend them. You should. You've earned it. As far as fund strategy goes, this is the one I intended about the twofold, right? So it's for the borrowers, right? Regularly lend to investor borrowers at favorable terms to support their entrepreneurial business. And as I mentioned, getting to see the transformation of neighborhoods and at the ground level, grassroots, if you want to call it, I just think that is something so cool that we should all be taking pride in. But then in switching that around and looking at the lender's perspective, right? First lien position, favorable loan to value, secured against residential assets that we would love to own. I look at a lot of our underwriting as like, man, if I get to own that property for that dollar amount, that's like buying property at a steep discount. Let's go. So that's our fund strategy. Always has been, always will be. As far as what we invest in and why, again, very, very simple. First lien, good loan to value, good collateral assets, and why. This is safe. This is low risk. It's predictable. Okay, it's like fixed income with a huge portfolio of assets that's backing all of this capital. All right, I don't like doing things that are unsecured. Risk-adjusted returns and repeat borrower business. Vince alluded to this. I mean, I've got borrowers that I've lent money to for more than a decade now, hundreds of loans. I love working with those guys. And one of the major reasons that even in the face of losing money, because the flippers lose money sometimes, they still step up and pay off the loan. And it's because they want to continue to do business with Marshall Reddick on the long term. So that repeat business, I think, is a niche that we fill. So again, as far as the portfolio holdings go, stay up to date in real time on this. This is a screenshot I took, I think, last evening as I was getting prepared with this PowerPoint and this presentation. This is available for you, and you can also dive in further. If you click on the state and on the number, it will show you the assets, and you can even dive into the underwriting and the metrics and the different interest rates and yields and all that kind of stuff. Again, sticking with our transparency model. We talked about the base tier at under 500, so our minimum investment of 25 up to 500. If you had invested with us from day one and you had been reinvesting your earnings from day one, like me, right? I'm on the growth model. I'd be earning that 8.5%. To speak to those capital account based profit splits, again, up to 500 is going to earn that 50-50. If you're over 500 and up to, but not yet including 3 million, you're going to earn an extra 10%. And for those heavy hitters up at the 3 million plus number, we are distributing 70% of the profit after the preferred return. Again, we're all earning the same preferred return, right? And the profit split is just management giving up a bigger piece of the pie after we've exceeded that hurdle. So why? Why Marshall Reddick Mortgage Fund? Why invest in this? I have a lot of folks that are rebalancing portfolios, a lot of CDs, bank CDs that are maturing, a lot of folks with money market accounts or high yield savings where the bank is starting to drop that yield as they're no longer competing or less heavily competing for those deposits, right? So if you're doing that, you got idle cash, you're looking for a safe place to put it, we'd love to have you. You might be replacing underperforming assets. Okay, might be getting out of something else that maybe didn't go the way that you thought it would. We'd love to have you, right? If you're looking for safety, you're looking for low risk, you're looking for cash flow. There's no upside to this fund, right? There's no appreciation. There's no tax write-offs here. This is straight cash flow. And if you're looking for growth, you just roll your cash flow back in and earn on your earnings. As I mentioned before, it's consistent, it's predictable, it's backed by real estate. And look, I know that past performance is not always indicative of future performance, but we got a good track record. You guys that know Marshall Reddick, that have been to our events, that come to our office, you know us. You know that we're doing the right thing. And so again, I'd love to have you guys. That's the why for me. As far as how, Vince, give it a go.
Yeah. Absolutely. So, you can always reach out to myself to book a consultation. I'd, of course, be able to get you access to the fund portal. We would work through accreditation, as Pat mentioned, not very difficult. There's a few pathways we can take. It's ultimately, at that point, a subscription agreement. We deposit the funds, and then it's a function of, tuning into these calls and whether you're collecting the distribution or reinvesting. It's pretty straightforward there. And then, as Pat mentioned, our portfolio is strong. So, as of 2026, 275 loans. We're at 62, just over 62% LTV, loan to value there. 85% is in single families, 80% with a loan term of under 12 months. And our core focus is on 10 major states. So with an average loan amount of just over 315. So very, very consistent, and something that we plan on continuing on.
Yeah, we're starting to tighten up our focus a little bit in terms of our states, right? We don't want to be too spread out. And a lot of times we have hyper focus in different states because we know a lot of people there. Having the ability to call upon realtors, property managers, attorneys if we find ourselves in trouble, right? People that can go like winterize a house in the Midwest, right? I don't know if you guys have been following the news or anything, but we had some significant snowstorms. Right? Sometimes we have the need to do that. And so while we want to maintain our diversity in geographic markets, right, I think 10 is still really good in terms of that number. We're going to try to hone that in as we get larger and really be in those locations where we know people and it's just a phone call away. As far as the average loan amount, right, that's taking the whole portfolio into perspective, that 275 loans. There was some other information about average loan amount earlier in the presentation. Don't get confused. Those were specifically for the quarter.
Thank you for clarifying that too, Pat. And, we are really, like we mentioned, we are really pleased with the performance, and we expect this to continue on. So, business as usual as we're kind of moving into 2026, at least in the forecast of that now.
I want to speak to this just really quick. I've had some people jump onto the call here and sort of ask about the real estate market and economic forecast and things like that. Look, we have no crystal ball either. Okay. But what I can tell you is that debt against residential real estate, regardless of the market, again, my opinion, I'm no, master economics guy, but if I've got a good loan to value and I've got a good collateral asset, and the market going like this, that's really the borrower's problem. It can become my problem from an underlying perspective, but if I'm in line in my LTV, I got plenty of room for that market to come down to squeeze that borrower. And if we've done and we got enough cash and enough skin in the game from them up front, right, they are not going to walk from that. It's going to be too painful for them to do it, right? They're going to have to make this decision of like, look, if I just walk away and leave the property in the lender's hands, I'm going to get zero money back. Whereas like I might lose money on this deal, but would I like to get 100 back, right? Which is my 50, my principal I've gone in and then 50 profits. Or you know what, in the face of catastrophe, would I rather get 25 back or zero? I'm only going to get 25 back if I stick in the deal, if I see it through disposition where I pay the loan off. Okay. So again, I don't have a crystal ball about what's going on out there, but I am in tune with the economics, right? I believe it's still a little bit uncertain. Who knows what's going to happen with interest rates? But at the end of the day, it's all about the underwriting. It's about how much skin that we're getting in the game, right, from the borrower. And again, if we have to take some of those assets back, I'm okay with that. If I have to hold them because we're in a down market, great. Let's put tenants in there and let's rent them. Let's start collecting rental income. We'll do whatever we have to do. I just don't see us having to do that given the diversity, the performance of the portfolio, the loan to value of the portfolio.
And one thing just to touch on, Pat, is you mentioned interest rates and potentially, what they might do. Just one thing to note, the fund was originated in 2020 and 2021 being some of the lowest interest rates that we've seen. So I just want everybody to know, as interest rates go down, those have been in for the fund long enough, that doesn't mean your yield goes down, right? Private money is its own separate market, and that space is very competitive. So ultimately, I think that yield stays very consistent regardless of really what the conventional interest rates are doing.
Mm-hmm. We've talked about it. Don't be stingy, right? Tell your neighbor about it. Vince's neighbor just invested with us. That's awesome. But we love your friends and family. Okay, your colleagues. Tell people about what's going on and the successes that you're having, right? So that we can grow this organically together.
Yeah, absolutely.
Yeah, the roadmap hasn't changed. It hasn't changed. Same roadmap that we've had, guys. We're just continuing on to 100, continued earnings. As I mentioned, we've grown the team. That's been fantastic. We've really enjoyed bringing on some new staff, including that underwriting manager. Can't wait her to get in front of all you guys and for y'all to get to meet her and to understand her background. Software, we're investing heavily in technology because we're realizing that efficiencies are super important. We've talked a lot about the REIT and the audit, so I'm going to leave that alone. Just know that it is coming sooner than you're expecting.
Any questions or anything that anybody needs? These are the contacts that you can find. My email is vtomich@marshallreddick.com, and then you have your mrmf@marshallreddick.com. I understand that there were some questions. I think Pat was fielding some of those. If there is any questions that are left unanswered or more dialogue that needs to take place in order to better understand the fund or specific situations, I will be making phone calls tomorrow and into next week to have those conversations. But feel free, if you want to be proactive or set something up, you can reach out to me directly to get that going.
Absolutely. Use this QR code. This will take you to where you can get onto our fund page. Okay. You can schedule a consultation. It just sends us a ping, right? We'll put you into the queue, right? You can get on with Vince, or if you already have an assigned fund consultant, no problem. But we'd love to have you join. Otherwise, I think we're here at time. We appreciate everyone as always. Again, it's my pleasure. Vince, you're the man. I really value your input and you jumping in with me every single time. And again, just thanks for all the capital partners.
Yeah, thank you, Pat. Thanks for everything. And thank you guys for joining.
Bye now.